Welcome back. We are jumping right back into our breakdown of the UP PGT Economics 2011 paper. This is part 4, and we're tackling questions 31 to 40. And let me tell you, this is where we get into some of the real heavy hitters of macroeconomics. We're going to talk about the theories that shape wages and interest, and then we'll pivot to the game-changing ideas of Keynes. These aren't just questions, they are the absolute foundation of modern economics. So, let's get to it.
Here's how we're going to break this down to make it super clear. First, we'll set the stage with the classical theories on wages and interest. Then, we're going to dive deep into the world of Keynesian economics. By looking at them this way, you'll really see how these big ideas connect and where they differ.
All right, let's kick off with our first block of questions. We're going to be looking at some of the most fundamental questions in all of economics. You know, the big ones. How do we determine wages? What sets the interest rate? And where do profits even come from? Let's see what the first question has in store for us. Okay, first question up is about the wage offer curve. So, what's it really telling us? Is it just about the paycheck a company is offering? Or is it about that trade-off we all think about? You know, working more versus having more free time. Or maybe how much you're willing to work for a certain wage. Take a second. Could it be all of these things combined? If you went with D, you are absolutely right. This concept really does wrap all of those ideas into one. The wage offer curve is all about labor supply. It's a picture of a worker's choice. At any wage, how do they balance earning more money against enjoying more leisure? And this choice is a constant tug-of-war between two forces. The substitution effect, which makes free time feel more expensive as your wage goes up, and the income effect, which makes you feel wealthier and able to, well, afford more free time. The curve shows that whole dynamic in action. Next up, we're switching gears from wages to interest rates. Now, if you're thinking like a classical economist, what are the key things that determine the interest rate? Is it all about the real stuff happening in the economy, or is it about monetary factors, or maybe a mix of both? The classical view, which folks like Professor Marshall championed, says that interest is a purely real thing. It's all about tangible forces in the economy. Think of it this way. It's about the supply of savings from people like you and me, and the demand for investment from companies that want to build things. The interest rate is just the price that makes those two sides meet. In this worldview, stuff like the money supply doesn't really enter the picture. Okay, this question is a great little test. It's asking you to tell these major theories of interest apart. You've got 3 statements here. Which one correctly describes the main idea of one of these theories? You have to really know the difference between the classical, modern, and liquidity preference models to nail this. And this table just lays it all out perfectly. As we just covered, the classical theory is all about real factors, savings and investment. Then Keynes came along with his liquidity preference theory and said, hold on, it's all about the money. He argued it's a purely monetary thing. And then the modern theory sort of brings it all together, saying, you know what, it's actually a mix of both. It synthesizes the two schools of thought. Here we have a who's who question from the history of economics. The innovation theory of profit was a truly revolutionary idea. So, which one of these famous economists came up with it? Was it Schumpeter, Hawley, Clark, or Knight? The man behind the idea was the one and only Joseph Schumpeter. He had a totally different take on profit. He said profit isn't just a payment for taking a risk. No, for him, profit is the temporary prize an entrepreneur gets for successfully shaking things up, for innovating. And an innovation could be a new gadget, a new way of making something, or even finding a new market. It's that act of creative destruction that gives them a short-term edge and, of course, the profits that come with it. Okay, everybody, buckle up. We are making a huge shift now. We're leaving the classical world in the rearview mirror and diving headfirst into the universe of John Maynard Keynes, a man who literally changed the field of economics forever. These next questions are all about his biggest ideas. Now, this is a fantastic question, and it's a little bit of a curveball. The second you see the word multiplier, your brain probably screams, Keynes, right? But read it again carefully. It's asking about the employment multiplier specifically. So who really came up with this concept first? And the answer is a bit of a surprise. It's D, none of the above. The employment multiplier was actually introduced by Keynes's colleague R.F. Kahn back in 1931. Kahn was the one who first figured out how a new job in one area could create a ripple effect of more jobs across the whole economy. Keynes then took that brilliant foundation and built his famous investment multiplier on top of it. A great piece of economic history. So let's talk about Keynes' multiplier now, the investment multiplier. What's the engine that really drives this thing?
What's the one factor that determines just how big and powerful this multiplier effect is going to be?
It all comes down to the marginal propensity to consume, or MPC. And the logic, when you look at the formula, is actually quite simple. The MPC is just a fancy term for, if you get an extra dollar, how much of it are you going to spend? The higher that number is, the more you spend, the bigger the multiplier's ripple effect will be throughout the economy. It's all in that simple formula, K equals 1 over 1 minus MPC.
All right, now for one of Keynes's most famous and, honestly, kind of strange ideas, he talked about this situation called the liquidity trap. So, in this weird scenario, what's happening with the interest rate? Does it become perfectly elastic, perfectly inelastic, or something else?
In this very unique situation, the interest rate becomes perfectly elastic. Here's what's happening. Interest rates are so incredibly low, they're practically on the floor. Everybody thinks they have to go up soon, which means bond prices will fall, so nobody wants to buy bonds. Instead, everyone just hoards cash. The central bank can pump tons of money into the system, but it doesn't do anything because people just hold on to it. It's like pouring water into a full bucket. At that point, monetary policy becomes completely powerless.
Okay, this next one gets a little more technical, but it's an important detail. We're looking at a specific kind of consumption function, a proportional one. In this particular case, what's the exact relationship between the average propensity to consume, APC, and the marginal propensity to consume, MPC?
The key here is that they are equal. The defining feature of this model is that the consumption graph starts right at the origin, at 0, 0. This means if you have zero income, you have zero consumption. What's cool about this model is that the proportion of your income you spend, your APC, stays exactly the same no matter how much you earn. And in this special case, that constant average is also equal to your MPC.
Let's move on to the acceleration principle. This is the powerful idea that a small increase in consumer demand can trigger a much, much bigger increase in business investment. But for this domino effect to actually happen, what condition needs to be true about our industrial capacity?
For the accelerator effect to really work its magic, you need to have existing excess capacity, specifically in the capital goods industry. Think about it. The principle says that when more people want to buy shoes, the shoe company will order more shoemaking machines. But that can only happen if the factories that build those machines have some spare capacity to actually produce them. If they're already running at full tilt, they can't meet the new demand and the acceleration effect just stalls out.
And here we are, our final question for this set, and it's a big one. It's about a cornerstone of Keynes's entire theory of investment, the marginal efficiency of capital, or MEC. So what is this concept really measuring? Is it a discount rate, an internal rate of return, capital productivity, or all of them?
And the answer is D, all of the above. The MEC is one of those brilliant ideas that elegantly ties several concepts together. At its heart, it's simply the expected profit rate from a new investment. That means it is, by definition, the same thing as the internal rate of return, or IRR. It's the magic number that a business calculates to decide if building a new factory or buying a new machine is worth the money. If the MEC is higher than the interest rate on a loan, it's a green light to invest.
So, let's quickly recap what we've covered. We've seen the huge difference between the classical school, with its focus on real factors, and the Keynesian world, which brings in money and expectations. And we even picked up a great piece of trivia that the multiplier idea actually started with R.F. Kahn. The big takeaway is just how these different theories try to explain the engine of our economy. I hope this was helpful, and I'll see you next time as we wrap up the 2011 paper in our final part.